Hi everyone, welcome again to another financial analysis video. Myself, Moeed Amin, and Ted Wayman. Today we're looking at Rolls Royce, as you can see from the logo in front of you. But before we get into that, don't forget to like, share, subscribe, especially if you've made the request for this particular type of business that you want us to analyze. You'll get the notification. So let's dive straight in. Rolls Royce. So a lot of you will know Rolls Royce as a very famous British business. You would have probably seen some of the cars around, but they're much more than that. So Rolls Royce are in the business of what's it called? Power and propulsion. So they manufacture power and propulsion, basically engines, and they do so for civil engineering, such as aeroplanes. They do so for the defense industry. They even have power propulsion engines and grids for yachts, for example. So very, very big business that has been around for a long time, as you can see, established in 1904. Now, I want to thank one of our viewers for recommending this video. And here's your video for you. So Kame asked us to look at that, as well as another company we've done in the past called Bidstack. One thing to note, and we've placed this on this slide here, just so that in your investment thesis, you're aware of this, and we will stick around actually, because we will go on to talk about this in more detail in relation to the fundamental financials. But essentially, the company pumps in a huge amount of money into developing, in terms of R&D and manufacturing the engines. So essentially, it doesn't really make much money when they sell the engines to aircraft manufacturers. Actually, they lose money. Where they make the majority of their money is based on the long-term service agreements, so repairs, etc., that they have. And the point to note about this at the moment is their shares are down by about 70% than they were 2 years ago. So could present an opportunity for you. Again, stick around, because we're going to start looking at the fundamental financials and how it probably connects to the to share price movement, but just worth noting so that you're aware of the context for what we're going to discuss today. And just on that note, on the share price, if you invested 5 years ago, you would have lost money, I think to the tune of about 50%. However, if you'd invested a year ago, you would have made around 268% capital gain. Now, as we always say, don't try to time the market. If Warren Buffett says he can't do it, then I think most of us can't. It's a mug's game, as Ted calls it, but it's worth at least noting that change. It's interesting to look at. So Ted, let's dive straight in and share with our viewers what we found about the finances of this long established institutional business.
Absolutely. So, well, good to see you, Moeed, and thank you very much. Yeah, once again, we are going to be looking at the financial analysis, and as a caveat, that means that this is a backward-looking presentation by its very nature. The numbers will tell us where Rolls-Royce has been in the past, not necessarily where they are going. So that little comment, which was in the Money Week recently, taken from the Daily Telegraph, as we saw, Daily Telegraph says that we think they're potentially are going to be making money because of the move to actually providing the services rather than actually developing the products, and therefore maybe they are an opportunity. So we will be looking at the past performance, and then as part of this past performance, maybe you would be thinking, as an investor, should I be adding these to my portfolio? Don't forget, this isn't just for investors, though. This is for people who want to learn how to read and interpret financial information. Maybe you're looking to supply to them. Maybe you're looking to join Rolls-Royce. Maybe you just want to understand financial information. So here is their annual report and accounts 2020. Again, quite out of date. We're now in October 2021 at the time of filming this. And if you look through their annual report, you'll find lots and lots of information about the business, and who they are, what they do, what their business model is, how their strategy is changing, who the people in charge are, etc., etc., etc. And what we're going to do is whiz all the way down through that. You can read that at your own leisure, simply by downloading it off their website. what I'm going to be doing is looking at the financial numbers, and they are available on page 106 of this report. So as a general rule, about halfway through, you'll notice there's 218 pages and we're on page 106. So what do we see? Here is the consolidated income statement, and the first thing we see at the top line, a big fall in revenue, and that will obviously be driven primarily through COVID, for example. So as a result of COVID, orders would have been cancelled, etc., etc. And this has caused a massive loss in revenue. Cost of sales are still very high, and therefore they make a loss, operating loss, down from an gross profit of 6%. So still very, very low margin in 2019, and then they tip into a loss. There's the research and development. So interesting enough, while they're in a loss, the R&D costs have gone up from previous years, and that's what the Daily Telegraph is really saying. They're saying, look, we expect these numbers to go down and the cost of sales to go down relative to the revenue. We should start to see some pretty hefty, beneficial numbers coming through. But that's not what they experienced in 2020. There's the loss for the year, and after the financing, so they've got some debt and they have to pay the interest. The total loss for the year, about 3.2 billion pounds. Okay, so a fairly hefty loss, and you'll notice they even were making a loss in the previous year. Okay, so this is a loss-making business, and they book a very big loss on 2020 based really on the pandemic. Let's leave the income statement there and move on to the balance sheet. So here is the balance sheet. In terms of their assets, so the non-current assets are the things that they need to run the business. There they are. It's about 15 billion of non-current assets. They're going to have some intangible assets up there. So some of that will be trademarks. Some of it will be goodwill, for example, and a lot of property, plant and equipment. Those are the two really big numbers that kind of jump out at us. And in terms of the current assets, inventories, which is their stock, they've got some trade receivables, and they've got some cash in the bank. Those are really the big numbers. That's what we'd expect, and that's what we see. These contract assets, these are a bit like work in progress. So where they're building engines for clients. So it's a kind of almost a part, bit like inventories effectively. So total assets, 29 billion, a little bit down from 32 billion in the previous year. Going on to the liabilities side. So scrolling down a little bit, here we go. Here's the liabilities. First of all, we see the current liabilities, 13.7 billion. That's this number here. So there's the current liabilities. Really not liquidity doesn't look like a massive problem. They've got 14.7 billion of current assets, 13.7 billion of current liabilities. Quite a lot of trade and other payables in there. A little bit of borrowings. These borrowings, they're probably going to refinance, I would expect. So liquidity doesn't look too much of an issue. And in terms of the non-current or long-term liabilities, really the big number here is this 6 billion of debt. Now, you'll notice that the debt has increased. Okay, so there's been an increase in the borrowings of this business, and that may be a little bit of an alarm bell. I'm not absolutely certain, but it's just kind of, if you're a loss-making business and you start to take on more debt, you're like, are you going to be able to afford that debt? Yet there's got to be some fairly detailed presentations to the debt providers, because they'll have wanted to see the strength of the future cash flows and the projections, and that will be not only contained within this document but also within some more sort of proprietary presentations to those debt investors. So it looks to me like these guys, they've taken on more debt. And I'm guessing, although we shouldn't rely on it, I'm guessing that the debt investors will have done a little bit of homework and will have confidence that this company is not going to go anywhere. What we do notice is this number here. Okay, and this number here is the net liabilities. The net liabilities means that for Rolls Royce, their liabilities are greater than their assets. So if this company ceases trading, the people who've lent them the money are probably not going to get all of their money back. I mean, there may be security sitting behind that. So you know, this company is technically insolvent. Okay, now you're allowed to trade if you're technically insolvent. You're not allowed to trade if you're actually insolvent, but you are allowed to trade if you are technically insolvent, as long as you can meet your financial obligations as they fall due. That's not the case, by the way, for banks or insurance companies, which have to have a positive net assets. So these guys net liabilities on the balance sheet, a negative balance sheet as we call it, and we can see that through the equity. So here's the equity, negative equity, and it's really driven by accumulated losses. So they're sitting on losses, but don't forget, losses, that's backward looking. That's what's happened in the past. And if you are an investor, you should be thinking about what's going to happen in the future. So the real question is, you know, are they strong enough to survive? You know, are they going to fall over, or are they going to carry on trading? I believe, and I'm sure somebody will correct me in the comments, but I believe that Rolls Royce has had to be bailed out in the past. So Rolls Royce, I'm pretty sure, has gone bust in the past, but because it's such a kind of iconic business, sort of part of the British psyche, it's been bailed out and nationalized and then reprivatized. It's happened in the past. It may happen again in the future, in which case you may lose your entire investment. So here's the cash flow. In fact, let's look at the movement in equity before we do that. So the movement in equity a little bit further down, if I can find it. Yeah, here we go. So here's the movement in equity, just confirming this kind of these losses. So starting with a loss at the beginning of 2020, they make a loss during the year, and they end up with an even bigger loss at the end of 2020. And again, you know, that's a kind of been the picture in the previous year as well. So retained losses. So this company is very much funded through the shareholders' actual physical investment. The cash flow also isn't looking too healthy. So negative cash flow for 2020. Now, positive cash flow in the previous year, but negative cash flow in this year. So a lot of it driven through, you know, they're making a loss and therefore they're generating negative cash. And that's, you know, kind of, you know, really where the you know, that is a cause for concern, because if you're burning cash, you can't afford to do that forever. So negative cash flow, little bit of investment going on. There's the investment in the kind of, you know, in future of the business, and then the financing. You'll notice positive financing, and that positive financing is driven through. Let me just change the color so we can see it. So it's driven through the issuing of debt. So you'll notice that they've borrowed 4.8 billion and they've repaid 2.8 billion, which means that they've taken on additional debt of 2 billion, and that's reflected in the increase in debt in the balance sheet. And you'll also notice that there is a share issue they undertook. So they've actually raised money by issuing shares. So debt and equity together to kind of fund the business to, you know, really, you know, this is funding for survival. This is not really kind of funding for investment or opportunity. So there's the kind of, there's the accounts. Now, we don't usually do this, Moeed. We usually kind of say, well, look, you know, there's the financial statements, and that's the latest piece of information. But I did want to just sort of pull up. These are the 2021 half-year results. Not a full set of financial statements, but I did want to highlight a few things that kind of jumped out at me looking at these half-year results. So first of all, this is a kind of high-level view of how they're performing. You'll notice that they've made this profit from operating activities. So it looks to me like 2021 they have or are returning to profitability. Certainly, the gross profit is up. They're operating at a gross margin of 21%. That looks very healthy. They've got the bottom line profit is good. You can see these negatives in the previous year where they were, you know, they were really booking that big loss effectively. So it looks to me like, you know, they have turned the corner for the first 6 months, and they're saying, look, you know, the restructuring we've done, that the movement of the business, you know, it is starting to pay dividends. A couple of other things, these are just on the segmental analysis. The other things to notice are they have a specific section here on improvement of free cash flow. And, you know, really thinking about, you know, the negative cash flow they experienced in the previous year, you know, they are very aware that you know, that can't last, and that they are addressing it. And so what we see here is the cash flow from 2020. We don't have to worry too much about exactly what this is telling us, but basically the cash flow from the negative cash flow from 2020, this is the first half of 2020, is, well, it's not a positive cash flow, but it's less negative. So what they are doing is say, look, we are going in the right direction. We are working with it in order to kind of, you know, to start generating positive cash. And the other thing I wanted to just highlight was, again, this comment here, rebuilding the balance sheet. And by rebuilding the balance sheet, what they're trying to do is to kind of is you know, they've got the, you know, they've taken on this additional amount of debt, but they are looking to you know, to dispose, to generate cash, to pay down that debt, and to increase their cash pile. So, you know, these guys are very aware of the cash flow, of the amount of debt they've got, you know, and this is a kind of, you know, they're trying to convince us that you know, they've got it all in hand, and that they are, you know, doing something about it, so to speak. So there is our analysis of the financial statements. Here is the share price, as we mentioned. So the actual market cap of the company is about 12 billion. Now, obviously, the balance sheet is negative, so, you know, that market cap is all goodwill by definition. The PE ratio, obviously, if you were to compare it to 2020, it would be 0. The P ratio right now is 3.6 times. Okay, now 3.6 times. You remember we looked at Tesla. Tesla once was 1,000 times earnings. This is, you're only paying 3.6 times earnings. Okay, that's relatively cheap. This looks like a potential bargain. It only needs 3 years before you get your money back effectively. That's what it's saying. So this looks to me like it could be a very, very cheap company. Now, it doesn't come without its caveats. There's a lot of debt. There's a negative cash flow. There's a negative balance sheet. So there's lots of caveats. Yet, if you buy into the underlying story, if you think about the kind of the value of the business, if you think that it can actually reclaim its heady heights of 2013-14, then maybe this looks an opportunity. And maybe we talk about market timing. Obviously, if you have been investing, if you were, you know, very, very clever, or lucky, should I say, and you'd invested here, then you'd be sitting on a nice tidy profit. But it looks to me like you haven't missed the boat. Okay, this is still, you know, if this company can get anywhere close to kind of, you know, its previous highs, then, you know, there's everything to play for. So it looks to me like, you know, the Daily Telegraph is probably right. It looks like it could be an opportunity, maybe not for the faint-hearted, and it will be a rocky ride. But I think that this is, you know, probably worth a bit of speculation. But I wouldn't sell my house and put it into Rolls Royce shares. Let's put it like that.
Yeah, very interesting. And of course, these are just our opinions, but we would really love to hear from any engineers who happen to be able to share some detailed information about some of the technologies, that obviously without giving away anything that's confidential, as we had from Tesla as well, where we had some engineers that wanted to share their opinions about the technology. So this will be great to see, and will be interesting to maybe come back to this business maybe in a few years' time, who knows, and see if those opinions were correct. But for now, thank you, everyone. Again, like, share, subscribe. If you have any businesses you would like us to analyze for you, whatever the reason is, whether it's investment, work, or you're trying to do business with them, do leave a note in the comment section, and we'll get round to your video as soon as we can. So thank you again, Ted. Thank you also, everyone, for viewing. And until the next video, bye for now.
See you later, Moeed.